I might just touch on a couple of the matters that Fiona raised first. One of the things Fiona said was the bank can only fund the acquisition of the asset, and an issue that raises is whether or not, once the funding's in place and the property's been purchased, any refinancing arrangements can be made. And the strict answer to that is no, because a refinancing is considered by the ATO to be a new borrowing of money, and each new borrowing of money, as we've heard, has to be applied towards the acquisition of a new asset. I had one example towards the end of financial year where the client had not spoken to their bank early enough and were due to settle the acquisition of a property in their self-managed fund. Thankfully, the bank was unable to get comfortable with, and it wasn't St George, but the bank was unable to get comfortable with settlement happening on that day. And thankfully for the client, they had enough money outside super to lend the money in themselves under a related party lending arrangement. So at the last minute, we drafted the loan and mortgage and settled on that basis. That left the client, though, in the position that they had their money tied up in this loan to the super fund, so we had to think of ways to actually get a bank in there to refinance it. So the arrangement we made was for the bank to take an assignment of the loan agreement and the mortgage, which is not considered to be a new borrowing, new lending of money to the fund, because that arrangement is between the two financiers, the two lenders. That is certainly not something that the banks will agree to lightly, in my view, and it's not something that's going to be packaged up as a product. But I think in the current regulatory context, where the government is saying things like people and consumers must have choice in the market, particularly in the banking market, I don't think they can allow this situation to persist, because it means that if customers need to change for whatever reason, the way the legislation works at the moment, they'd actually have to sell the asset just for the sake of terminating their current arrangements with their lender. So I'd watch that space. The other comment was concerning loan terms, and that can kick off my discussion of compliance imperatives. St George, along with all the other banks in this area, are prepared to loan up to 25 to 30 years. In the context of self-managed funds and any retirement funding, in many circumstances that's not going to be feasible or appropriate for people who might be planning to retire within 5, 10 or 15 years. The approach which, say for instance, Cleardocs takes is they apply, for the related party lending, they apply a maximum term of 20 years, and if customers wanted to have a longer term loan than that, they can speak to Maddix about having the documents amended and so on. It's a relevant consideration really for people in your position who are advising clients on how they should set up these structures and how they should design loan and principal repayments over time. Is it really appropriate if people are going to be retiring in 5 or 10 years and ceasing to earn an income to enter into a loan for 25 to 30 years? So the compliance imperatives are really amplified by the presence of debt on the balance sheet of super funds, which we're not accustomed to, and this regulatory superannuation overlay. And the first point is about investment strategy. True, the bank wants to see that the clients and their advisors have turned their mind to it, but it's up to the clients and the advisors to make sure that, one, that there's an investment strategy in place. In my view, it should specifically contemplate the borrowing and be tailored according to the fact that one of the assets in the fund will be leveraged. The presence of that debt the purchase of the asset itself might be consistent with the investment strategy, but where the asset's leveraged, that can distort the investment strategy because poor or exceptionally good performance over time will require a re-evaluation of that investment strategy. There might be an overexposure to that particular asset, which, unless you're looking at the liabilities side of the balance sheet, isn't apparent. And the other point on investment strategies is that the presence of debt also, I would argue, requires you to revisit that strategy more regularly. On the topic of interest, this is perhaps of more relevance to related party lending because the key message is make sure that the interest rates are struck at an arm's length or commercial basis, and that's necessarily going to be the case when you're dealing with the bank. Related party lenders, though, you can negotiate your own rates of interest, and in the context of greater than commercial interest rates, then the regulator's concern is likely to be, well, we think that's a way of funneling money out of your superannuation fund, contrary to the sole purpose test, which is the money in your fund must be applied for the sole or primary purpose of retirement. It may also offend the rules in relation to lending financial assistance to members. So if you're striking a greater than commercial rate of interest, Section 65 of the SIS Act says you can't lend financial assistance to members or relatives outside the fund. If you've agreed to pay a high rate of interest, then arguably that's one means by which you're providing that assistance to those people outside the fund. In the case of interest rates at a less than commercial rate, so extreme example is zero rate of interest but still with an obligation to repay under the loan agreement, then the ATO has commented that they could consider that to be in fact a contribution to the fund made by a member or some other related party. That raises the spectre of contributions tax, and particularly where you may have clients who have reached or nearly reached their contributions limits to get money into the fund to purchase the asset, then it raises the spectre also of excess contributions tax. The issue around capitalising interest again gets back to each new borrowing of money has to be applied towards the purchase of an asset. And if there is interest outstanding and that interest is capitalised by agreement or by the terms of the loan agreement, then the ATO has said we consider that to be a new borrowing of money. The legislation requires each new borrowing to be applied towards the purchase of an asset. That's not what's happening here. And that is therefore contrary to Section 67. So loan agreements will ordinarily apply, say, a default rate of interest rather than having a capitalising provision. So personal guarantees. We've seen how they may be required in some circumstances, particularly given the limited recourse nature of these arrangements. And there are two real issues, compliance issues here.